Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 11 of what is now going to be my 12-part video series on Roth IRA conversions. In this video, we're going to calculate the answer to one of the eternal retirement questions that most folks will face as they move from the employment years to the early retirement years. Let's break the question down into multiple parts as follows. Starting right here, is it better to take Social Security early in order to help cover living expenses and cash flow needs now in early retirement, and so that we can let our traditional IRA money grow on a tax-deferred basis for as long as possible? Or over here, is it better to take traditional IRA distributions to help cover living expenses and cash flow needs now, i.e. in early retirement, so that we can let our Social Security benefit grow as much as possible by delaying the start date? In addition to that, can we determine a break-even point where we would be indifferent between the two options above? And then finally, how do we incorporate these questions into our Roth IRA conversion planning? Let's take a look at the 4 questions we just went over in the context of our Roth IRA conversion timeline, while also considering the 3 main pillars of retirement cash flow, which are as follows. Number 1, Social Security. Number 2, IRA distributions, whether they come from a traditional or Roth IRA. And number 3, pensions or annuities, where annuities are just basically personal pensions that you can purchase. We do have other types of possible retirement income that can include rental income, business income, royalties, investments that are not inside of retirement accounts, inheritance, and I'm sure there are many others that can go on the list right here. However, for purposes of this video, we're going to focus on the 3 main pillars, and specifically we're going to focus on these 2 primarily: Social Security versus IRA distributions. And right down here, let's rephrase the question in the simplest terms possible. Where does money come from when you are post W-2 and pre-RMD? In other words, if we look down here at our Roth IRA conversion timeline, in particular the early retirement years, which are going to fall somewhere in this range right here, we have talked extensively and in fact are working right now inside of the Fast Track program within the personal tax planning template on calculating taxable income within the early retirement drop. However, taxable income and cash flow are 2 different things, are they not? Taxable income is the amount of income which may be subject to tax in any particular year. That does not necessarily correlate with cash flow, which is the amount of money you're going to need to cover all of your expenses in any particular year. And so we have to look at these 2 concepts side by side, because while you are taking the time to figure out your taxable income in the early retirement drop, that is something which we can't really do in isolation. We have to make sure that you have sufficient cash flow to cover your needs during early retirement. And that's where the question that many people face can come into play. Should you start Social Security earlier in the range, thus delaying distributions from your traditional IRA, thus allowing that money to grow for longer pre-tax? Or should you start taking distributions, even though they're not RMDs, taking distributions from your traditional IRA to cover living expenses in order to allow your Social Security benefit to grow, because you have delayed the start date to somewhere out here towards the end of the Social Security start range? Those are cash flow questions, which is different than the amount of taxable income you may have in the early retirement drop, but they need to be figured out side by side because while they are separate concepts, they both are interrelated, and therefore we have to talk about them in conjunction with one another, which is the point of what we're going to be doing in this video. Alright, so now that we've laid out the basics, let's start calculating the answers to our eternal questions about finding the right balance between number 1, cash flow planning, and number 2, tax planning in the early retirement years. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments what questions and issues you're facing as you build out your ideal retirement plan. Okay, so here we have Seth and Darla Roberts. The couple is trying to decide the best way to handle cash flow needs during the early retirement years. And as I mentioned moments ago, they're isolating 2 pillars of retirement income for purposes of completing this analysis. Specifically, as I mentioned before, they're comparing Social Security started at different points in time versus taking IRA distributions to cover the shortfall in cash flow needs that could occur by delaying Social Security in order to identify which combination of strategies provides the best result for their family. And that brings us back to the first 2 of our original 4 questions. What is the best way to manage cash flow, i.e. to have the money you need each year to cover your needs during the early retirement years? Is it better to take Social Security early and let the funds in your traditional IRA grow for longer on a pre-tax basis? Or is it better to utilize traditional IRA funds early and thus let your Social Security annual benefit grow by delaying the start date? So here is the Roberts family Social Security starting benefit values based on age when they might begin to collect. So for example, at age 62, spouse number 1 could receive an annual starting benefit of $16,512, and spouse number 2 could receive an annual benefit of $13,980 for a grand total of $30,492. At the other end of the chart, if the couple was to wait until 70 years old to start collecting, spouse number 1 has an estimated benefit of $35,544, and spouse number 2 has an estimated benefit of $33,012 for a grand total of $68,556. Now, as a quick tip, when you start your retirement planning, you don't want to just guess and make up these numbers right here. You might consider setting up an online account with the Social Security Administration if you have not done so already, so you can get access to this information for yourself and your spouse. Note that many of you may get an annual statement in snail mail with this information already on it. Somewhere within your SSA account or on your annual statement, you're going to see a projection very similar to this. It's going to show you for each person what your projected starting benefit is going to be depending on what age you choose to start collecting. So this would be a great thing for you to get your hands on from the SSA for your specific situation so that you can make the most informed planning decisions possible. Alright, before we dig deeper into the scenario for the Roberts family, let's set up a quick pop quiz for later in the video. The questions we want to consider as we work through the video, which we will then come back to toward the end, are as follows. Why is the Social Security versus IRA distribution decision a cash flow decision? Versus number 2, why is the Roth IRA conversion decision a marginal tax rate decision? We will think about those pop quiz questions as we work through the remainder of this video. So now going back to the Roberts situation. For mathematical simplicity, we are going to assume the following items in this example. Number one, we're going to assume both spouses are the same age. By doing that, we can simply look straight across this chart and say, well, they're both going to be 62 at the same time, therefore these will be their combined benefits right here if they decide to start taking Social Security at 62. For purposes of this example, we're just going to use a rounded $30,000 for this scenario. Alternatively, when we compare the scenario of waiting to collect Social Security to the age of 70, we're going to use a rounded $68,000 as the combined benefit. All right, assumption number two is that the couple needs $73,000 of after-tax cash flow annually to cover living expenses. Now, before going on, some of you may be looking at this number and thinking, okay, that's pretty reasonable for my lifestyle. And some of you may be looking at this number and saying, well, that's really low for my lifestyle. However, regardless of what your thoughts were on this particular amount, remember that we're just doing an example which you will be able to repeat using the tools that we are going to go over in this video, and you're going to be able to make your after-tax projected cash flow needs whatever number you want, whatever number is the most realistic for your situation. So keep that in mind as we go forward. Okay, item number three, this example will last for 28 years from the age of 62 to the age of 90. Item four, again, just for mathematical simplicity, we're going to ignore inflation in both A, the Social Security benefit itself, and B, the cash flow needs, i.e. the cost of living over time. We're just going to assume that they are equivalent. In other words, the Social Security benefit and the cash flow needs will grow at the same rate, and therefore we're going to remove inflation as a variable in this example by setting it equal. That way we can focus on the underlying concept of Social Security versus IRA distributions without making the mathematics too complicated. Obviously, for those of you who are in the personal tax planning template program, you know that we have the inflation adjustments built into the template for all purposes, including Social Security benefits, including the tax brackets, including for IRMA, including for many other purposes. But again, for purposes of this video example, we're just going to set that equal and remove it as a variable. Finally, number five over here, we're going to assume that the combined traditional IRA balance for the Roberts family at age 62 is going to be $2 million. Okay, so let's hop into the first example where the couple decides to take Social Security starting at age 62. So as we previously determined, the couple will be able to receive a $30,000 annual benefit if they start at age 62. That number comes from right over here in this table, which we looked at earlier. As we discussed before, this example is going to go for 28 years, so collecting $30,000 per year for 28 years results in $840,000 collected. Now, the couple needs $73,000 of annual cash flow, and this $30,000 right here is not going to be sufficient to cover all of that. So to make up for the shortfall, we will need to take an IRA distribution, and I've determined the amount to be approximately $64,500. The reason it's $64,500 is because if we add these two numbers up, 30 plus 64.5, we get $94,500 right here. That's going to be our pre-tax income in this example. Now, when we go down to the next part of the chart right here, we're going to assume that the full Social Security benefit is taxable up to the maximum of 85%, and therefore $30,000 of gross Social Security benefit multiplied by 85% gives us a taxable benefit of $25,500. Now, regarding the IRA distribution, we are just going to assume that the full distribution is taxable, $64,500. We are going to ignore any possibility that some portion of this distribution may not be taxable because a portion of your contribution in earlier years, whether it was to an IRA or a 401k that later rolled into an IRA, some portion of that was non-deductible at the time of contribution for whatever reason. If you have that issue when you are filling out your personal tax planning template, there is an entire section inside the members area. It is called non-deductible IRAs, and it goes over everything you need to know about IRS Form 8606, which is where you determine how much of this IRA distribution is non-taxable. However, with that said, for purposes of this example, we will assume that the full distribution is taxable, leading to $25,500 plus $64,500 is $90,000 of taxable income. Now, throughout the example, I'm just going to use an assumed 24% marginal tax rate. We have not considered the couple's other income items. We're simply comparing two items in isolation, a Social Security benefit and an IRA distribution. So we're going to ignore the graduated tax brackets. Those are all built into the personal tax planning template, as many of you have seen and have used. We're just going to go with a flat 24% marginal rate for simplicity, resulting in $90,000 times 24% is an annual tax of $21,600. And then right here, to determine our after-tax cash flow for that particular year, we're going to take our pre-tax income from up here, and we're going to subtract off the tax due right here of $21,600, resulting in after-tax cash flow of $72,900. Remember, I said the couple needs $73,000 of annual after-tax cash flow. So for purposes of this example, this is close enough. And by the way, it was getting this number close enough, which is how I determined how much gross IRA distribution was required. For example, if I wanted this to be exactly $73,000, we could go into our gross IRA distribution right here, and maybe let's just change the number to $64,600. Okay, we're a little bit closer right there. Let me go in and change it to $64,700. Okay, we just went over the $73,000 mark. So somewhere between $64,600 and $64,700 is going to be like the precise number that we need in order to get down to our annual after-tax cash flow needs of $73,000. But again, for purposes of this example, I'm just going to try to keep things simple and say that that's close enough. Okay, so let's take a look at some of the results here. So if we take a $64,500 annual IRA distribution for 28 years, that will be a grand total distribution of $1,806,000 for a grand total pre-tax income of $2,646,000. Right down here, if we're paying tax of $21,600 on this particular setup for 28 years, we would be looking at $604,800 of tax, leaving an after-tax cash flow over 28 years of $2,041,200. That's the same grand total that we have right here. I'm only putting it down here because in the next example, we're going to have multiple components that go into this. So I want the two different results to be visually comparable when we get over to here in the next example. And then finally, right here, the remaining pre-tax IRA balance. Now, this does not include any projected growth within the IRA, which we will layer on to this example in a few minutes. But for now, as a starting point, let's just see how this $194 is calculated. And it's very simple. We're just taking the $2 million starting point and we are subtracting off the $1.8 million of IRA distributions over the 28-year period. Let's assume for simplicity that the $64,500 was sufficient to meet their RMD requirements. And therefore, whether it was a pre-RMD distribution or an RMD distribution, it doesn't make any difference. They were still taking $64,500 out on an annual basis. And so to summarize this example at the highest level before we go to this one down here with Social Security at age 70, between a combination of receiving Social Security Security and taking IRA distributions, the couple had $2,041,000 of after-tax cash flow over the 28-year period, and the remaining pre-tax balance in their IRA at the end of that 20-year period was $194,000. Okay, now coming over here to starting the Social Security benefit at age 70. On this side of the chart right here, the left side, this is the example that we just went through on the previous tab. I simply copied it over here for comparison purposes. On the right side of the chart right here will be the example where the couple starts taking Social Security at age 70. Note that in both examples, the couple is 62 years old when the example begins. The difference is not their age when the example starts, but rather their age when Social Security starts. So in this case right here, in the first section of this chart, the couple does not have any Social Security benefit being received because they're only 62 years old and they are going to wait to age 70 to start collecting. Therefore, they're going to take IRA distributions only for purposes of covering their cash flow needs for the first 8 years of this example. Now again, they are going to need approximately $73,000 of after-tax cash flow to cover their needs. And therefore, when we work backwards in the math, they are going to need an approximately $96,000 annual traditional IRA distribution for the first 8 years. We are again going to assume that is all taxable multiplied by the 24% marginal rate that we are using throughout these examples. That leads to $23,040 of tax and approximately $73,000 of after-tax cash flow. Now, in the remaining 20 years in this part of the example, the couple is now going to receive a gross Social Security benefit of $68,000. Going back to the original chart for a second, do you recall we said this rounded $68,000 would be the combined benefit for the couple if they waited to age 70 years old to start? So back over here, a $68,000 annual benefit for 20 years, because remember this is a 28-year example and the first 8 years up here there was no Social Security benefit. Therefore, for 20 years right here is $1.3 million of benefit received. Now the couple is still going to have a shortfall in their $73,000 of after-tax cash flow needs because this is only $68,000. This is also a pre-tax number, as well as the IRA distribution gross is a pre-tax number, and so I've determined that they will need approximately a $24,800 annual distribution, which will give them pre-tax income of $92,800. Again, we're assuming 85% taxable on the Social Security, so that's $57,800 taxable. The full IRA distribution is taxable at $24,800. That leads to taxable income of $82,600 multiplied by our 24% marginal rate gives us tax of $19,824 on an annual basis. And then we take our pre-tax income of $92,800, we subtract off our annual tax, and we get our after-tax cash flow of $72,976, which again is close enough to our $73,000 goal for purposes of this example. Okay, so let's analyze the grand total results right here. For this one, we're going to have two components. It's going to be the after-tax cash flow received for the first 8 years of the example right here, plus it's going to be the after-tax cash flow received for the 20 remaining years right down here, and the grand total of that is going to be $2,043,200. Now here's what I want you to notice at this point. The amount of after-tax cash flow generated to cover the couple's living expenses for the 28-year period is effectively identical in both examples. I'm just going to assume that this number and this number are, for all intents and purposes, the same. We are slightly off due to a very minor discrepancy between this 72.9 and this 72.976. But again, we're just assuming those are both 73, and therefore these amounts are equivalent for our purposes. It did not matter whether the money came out of the traditional IRA or it came from Social Security for purposes of meeting the annual cash flow needs as this example is set up. However, we do have a significant difference right down here in the remaining pre-tax IRA balance. This number right here starts with the original $2 million, which is in this cell off to the left, F19. You can see the 2 million pop up right there above the number. And we are subtracting off the gross distribution of $786,000 for the first 8 years, as well as the gross distribution of $496 for the remaining 20 years, leaving $736,000 in the traditional IRA as compared to only $194 in the first example. And so in this fact pattern, the amount by which you are ahead in the traditional IRA, if you choose to delay Social Security until age 70 versus starting it over here at age 62, is going to be an increase of about $540,000. Okay, now at this point in the analysis, you can see that we are substantially ahead overall if we are not considering rate of return inside the traditional IRA. However, you are probably asking, but what about rate of return inside the traditional IRA? More specifically, is there a rate of return that we could obtain within the traditional IRA such that if we actually went with scenario 1 over here and took less money out of the traditional IRA, particularly in the earlier years? For example, see over here, we're taking $96,000 annually out of the traditional IRA for 8 years. But over here, for the first 8 of these 28 years, we're only taking $64,500. That's a difference of $25,500 annually for 8 years. What if that money remained inside of the traditional IRA to grow on a pre-tax basis, which it is remaining right here in example 1. However, we haven't applied any rate of return to the traditional IRA yet, therefore you can't see the effects of leaving that money in there for a longer period of time versus pulling it out in the early years in order to let that Social Security benefit grow by delaying the start date. And so the question becomes, what is the break-even point? This was question number 3 that we asked at the beginning of the video. Is there a break-even point that we can identify such that a certain rate of return inside of the traditional IRA would actually make this example over here, starting Social Security at age 62 and thus taking less out of your IRA in the earlier years? Is there a rate of return that would actually make this scenario more favorable? And so let's go over here to our break-even point analysis and see if we can figure it out. Before we do, let's just remember these numbers: $64,500 annual IRA distribution for the full 28 years in example 1 versus $96,000 for 8 years in example 2, followed by $24,800 for the remaining 20 years. Okay, so we're over here in the break-even point analysis on the left side. This is going to be the example where we take Social Security starting at age 62. On the right side, this is the example where we take Social Security starting at age 70. So in both cases, the couple is 62 years old at the start of the example. We've said that before, no change there. The opening balance, we're just assuming a combined balance for the couple is going to be $2 million. That's the case in both scenarios, no change there. Now in the first example, we're going to be taking a $64,500 distribution for the first 8 years, as well as for all of the remaining years, going down for the full 28 years in this example. However, over here on this side, we're going to be taking $96,000 of distribution for the first 8 years, and then we're going to transition over to $24,800 for the remaining 20 years in the example. Okay, so going back over here, many of you have seen this before. We're going to take the opening balance. We're going to subtract off the distribution. That leaves a balance after distribution. We're going to apply an annual growth rate starting with 2.5%. That leads to portfolio growth for that year of this 1.9 million multiplied by 2.5% is about $48,000. And that leaves an ending balance in the portfolio of this 1.9 million plus this $48,000 of return leads to $1,983,000. That $1,983,000 carries forward to become the opening balance for the subsequent year, and then the process just continues over and over on an annual basis. The exact same calculation is occurring over here. You can see the same setup, the same growth rate, the same ending balance is becoming the opening balance. The concept is the same on both sides. The only difference is the amount of distribution. A larger distribution here to cover the shortfall because we were not collecting Social Security. A smaller distribution right here because we were collecting Social Security early and therefore needed to take a smaller distribution from the traditional IRA. Okay, so with that setup in mind and considering a growth rate of 2.5%, let's scroll down to the bottom right here and see which one produces a larger ending value. So right here on the left side, with an annual distribution of $64,500 for the full 28 years, we end up with an ending balance, a pre-tax ending balance in the traditional IRA of $1,325,000. Alternatively, by taking a larger distribution over here for the first 8 years, but then taking a smaller distribution for the remaining 20 years, we actually end up with a pre-tax ending balance in the traditional IRA of $1.957 million. And so again, right here with this growth included, we are still ahead in scenario number 2, taking the Social Security starting at age 70. We are still ahead on a pre-tax basis in the traditional IRA by $632,000. So where is the break-even point? What amount of growth is necessary to get these two options to flip around? In other words, what rate of return would actually get this scenario over here, number 1, to produce a bigger result than this scenario over there? In order to test that out, I have just thrown in a rate of return toggle right here. This is linked to all of these cells up here. So when we adjust this number, you will see all of these rate of return items on each line change accordingly. So let's test it out. At a 2.5% average annual rate of return over those 28 years, we are ahead in scenario 2 by $632,000. What if I go in here and change this to 3%? Well, we're actually still ahead by $635,000 with scenario 2. How about changing this to 4%? Not much change, $632,000 ahead. How about 5%? Now it's starting to come down, $609,000 ahead. Now keep a close eye on this. This is the effect of compound interest. What if I change that to 6%? Starts coming down into the 500s. How about 7%? Down into the 400s. How about 8%? Down into the 300s. 9%. Only $143,000? 10%. Now it switches. We are now ahead in the other scenario. This number over here, 21.18 million, is larger than 21.043 million. And the larger I increase the rate of return, let's say 15%, you can see that scenario 1 starts to get a more and more favorable answer than scenario number 2. Now, I know some of you are looking at these numbers and saying, okay, wait a minute, $87 million, that's probably not realistic for my fact pattern. And I would agree, it is highly unlikely you are going to achieve an average annual rate of return of 15% in your IRA, in particular as you get into the later years of your life, when most likely you are going to be transitioning to more conservative strategies. The point of this exercise was pretty much for us to find this 10% right here, which is roughly what it takes takes to make these two equivalent. But anything less than that, anything which most folks would consider to be more of a reasonable rate of return, in particular in the retirement years, like let's say 4%, or perhaps let's say 3%, or let's say even 2%, all of those rates of return are going to give you a better result over here by delaying the start date of your Social Security. That is the underlying mathematical reason why most folks will recommend to you to delay Social Security as long as possible. Certainly to delay it for at least the first couple of years when you could potentially take it early. And to say that in a slightly more summarized way, you would need to be able to obtain a 10% rate of return in this fact pattern on an annual basis all throughout retirement in order to actually get ahead in your IRA portfolio by taking less money for Social Security and letting more money grow inside the IRA versus taking more money out of the IRA early so you could get that higher Social Security benefit. And why is that? What does that imply? It implies that there is an inherent internal rate of return. There's a rate of return to you on allowing your Social Security benefit to grow. And in order to overcome that built-in rate of return benefit that is inherent in allowing your Social Security benefit to increase by delaying the start date, to overcome that, you would have to achieve a 10% or greater rate of return in your portfolio in this fact pattern, which is going to be highly unlikely by most normal standards. And therefore, you can see that without the return or with the return baked into your portfolio, it is still generally beneficial to delay the start date of Social Security. Let's actually go now right here to this tab, the Social Security Internal Rate of Return Calculator. All right, here we are on the calculator. I am going to upload this to the members area for the personal tax planning template so you can drop your numbers into this if it is an analysis you want to perform in general or as part of figuring out what your taxable income is going to be during the early retirement drop, which is what we've been working on this week in the Roth IRA conversion fast track program. So let's do a quick walkthrough of this calculator and see how it works, starting right here in the Social Security entry row. This is where you would enter your 8 values that you can obtain estimates of from the Social Security Administration. These would be what your projected benefits are going to be depending on how old you are when you choose to start collecting Social Security. Here is your starting age line between 62 and 70. So let's see how this works. Starting right here in year 0, you could choose to collect $16,512 as your annual benefit. We're going to ignore the effects of inflation again because it would apply equally to all of these different columns. So for column 1, we're just going to assume that the annual benefit is $16,512 for the full 28 years all the way to the bottom. Now, if we wait for 1 year, what are we giving up? Well, we're giving up 1 year of $16,512. And in return for giving up 1 year of $16,512, we receive $18,192 starting a year later and then stretching out for the rest of life expectancy. If we wait 2 years to start, what are we giving up? Well, we're giving up 1 year of $16,512, we're giving up 1 year of $18,192, and in exchange for giving those two things up, we are willing to take $19,884 starting 2 years later and going to life expectancy. And this process will continue each year. Each year you give up 1 more year of the previous amount of Social Security until we get all the way out here to the final final year. Right here, you have chosen to give up $16,000, $18,000, $19,000, $22,000, $25,000, $28,000, $30,000, and $32,000. And in exchange for giving up those amounts, you have chosen to accept this number right here, $35,544, and you're going to get this amount starting here and going out through life expectancy. All right, now going down to the bottom of this chart, if I click on one of these right here, you can see the grand total amount received. And if I click on any of these, you can also see that it includes the amounts that you have given up. So just as an example, if you collect 16,512 for every year all the way through life expectancy, you would receive 478,848. On the other hand, if you give up these three amounts so that you can start Social Security later, and you accept 22,220 for all of these years, the grand total of everything that you received less what you gave up is going to be 523,132. And so each of these columns can have an internal rate of return applied to them. And let's see if we can figure out how to interpret this internal rate of return so that it makes sense. This number right here, 110%, is saying that the present value of giving up this amount of money today while receiving these amounts of money in each future year implies a rate of return on your money of 110%. However, if we go to the next column, giving up this amount of money this year plus giving up this amount of money next year in order to receive these amounts of money into the future, that implies a 47% rate of return on your money on a present value basis. And the concept for each column would be the same. There's a 31% return on your money by giving up these three amounts, but accepting these amounts into the future. And you can see that the internal rate of return is decreasing as each year passes. And I think the biggest takeaway to have from this information right here is not to focus so much on the percentage itself, but to take away the concept that waiting 1 year is extremely valuable. Waiting for 2 years is also valuable, but the value of waiting the second year is not quite as valuable as waiting for the first year. Along the same lines, waiting for 3 years is valuable. However, the value of the third year is not quite as valuable as the value of the second year, which is not quite as valuable as the value of the first year. This is like the law of diminishing returns. When you eat that first ice cream cone, it is really, really good. But when you eat that second ice cream cone, yeah, it's pretty good, but it's not quite as good as the first ice cream cone. When you eat that third ice cream cone, it's starting to not be quite as good anymore. It still might be good, but it's not nearly as good as those first two. And when you get to that fourth ice cream cone, oh my goodness, now you're starting to feel a little bit sick. You might have to pop a few Alka-Seltzer. The fourth ice cream cone is just not nearly as good as the first three. That is the law of diminishing returns, which you can see right here, and I think that's the most important conceptual takeaway to have. For example, if you're out here and you're struggling between should I start at 68 or should I start at 69, the incremental value to you is not nearly as great as it was when you were making the decision to start, let's say, between 63 and 64. It still may have value, but it has much less value at the margin. Now, one more question when looking at this chart. I have also calculated just a regular rate of return based on how much money you would get by waiting a year versus how much money you would get if you took Social Security right at the start. If we go into one of these, for example, and just look at the calculation, it is the new number right here minus the old number that you would have received divided by the old number that you would have received. New minus old divided by old. That is how you calculate a general rate of return. And what I want you to take a look at with this row right here is that you can see by waiting, your overall rate of return starts to increase and increase and increase. But then what happens right here? Why is the rate of return going down the longer you wait to collect? And the answer to that is a very practical issue, which unfortunately all of us are going to have to deal with at some point, and it's that this person died. They passed before the benefit of waiting for the higher amount of Social Security was able to exceed the amount that they gave up at the beginning. If, for example, we extended this chart out beyond 28 years, remember this person is starting at age 62 up here and going out to 90. So let's just make another copy of this tab right over here, calculator number 2. I'm going to extend this out beyond 28 years. Okay, here is the same Social Security analysis chart, but instead of going out the 28 years, I've just decided to go out 47 years. Keep in mind that that is probably unrealistic because it would make this person about 109 years old. I'm not saying that's impossible, but obviously that doesn't happen particularly often. However, the point of this exercise is just to show you that if you extend the chart out far enough and you can collect the larger amounts of Social Security for long enough, then your rate of return will always continue to increase over time. And that should make sense because you're only giving up a certain amount. This amount that you've given up here is fixed, whereas this amount can go on forever as an annuity, except for the practical limitation that people are going to die. Otherwise, this would just go on forever, and obviously you would want to wait for this one if you had unlimited time. So going back over here, that's another consideration you might have when you're making the Social Security decision. It may not be just about we should push Social Security out for as far as possible, in other words, all the way to age 70, because by pushing it out all the way to age 70, the amount that you give up relative to the amount that you receive within your expected lifetime, there may not be enough time left based on your facts and circumstances to actually get a benefit by doing that. The sweet spot, so to speak, for this particular fact pattern, and it's going to be different for every person. That's why you have to lay out your numbers and figure out what is best for you, because the amount of Social Security you receive will be different than someone else. The amount in your IRAs will be different than someone else. Your rates of return will be different than someone else. Your health and life expectancy will be different than someone else. For this particular fact pattern, the largest overall return is actually obtained right here if you start Social Security at age 67. Now, does that mean if you lay out all of your numbers and let's just say you got a similar result and this was the largest rate of return percentage on the chart, considering that this person lived to be 90 years old approximately, and you think that's a reasonable life expectancy, does that mean you should automatically just take Social Security starting at 67 as opposed to waiting a little bit longer? And I'm going to give you the answer of no to that. There is no one particular data point that is going to decide for you. On the other hand, instead of saying that this is the most valuable thing, that getting the overall highest rate of return on what I received versus what I gave up, maybe that's not the most important thing. Maybe to you, in your situation, having $35,000 a year is better than having $28,000 a year, and you're willing to give up the fact that over time you may actually collect less in this scenario than you would collect in this scenario over here, 552 versus 574. You're willing perhaps to accept that possibility in order to obtain an additional, let's say that's about $7,000-ish on an annual basis by waiting 3 additional years. That is the reason why we lay out all of our numbers inside of the personal tax planning template, so that we can play with these different scenarios and figure out what makes the most sense for us, because every person is going to have a different answer. Every person is going to have different desires and goals, different starting points, different risk tolerances, and so forth. So this is just another tool that you could look at inside of the personal tax planning template program to give you some different data points to think about as you decide what kind of taxable income you could be looking at in the early retirement drop, which again is what we're working on this week inside of the members area, and also to help you figure out your cash flow needs. For some people, the amount of Social Security will not be that relevant to your cash flow needs. For many Americans, it will make up a big portion of the 3 pillars of their retirement income, and therefore the decision is critical. And by looking at these different data points for your facts and circumstances, it will help you hone in on what is the most appropriate planning decision for yourself and your family. Right, so let's go back to the original pop quiz that we set up earlier in the video. And the questions were, why is the Social Security versus IRA distribution decision a cash flow decision versus why is the Roth conversion decision a marginal tax rate decision? And the way you might consider that for purposes of what we've discussed in this video, if this blue rectangle represents your cash flow planning, and this green rectangle right here represents only what's happening inside of the IRA vehicles. The Roth conversion is just this part of the decision and can be made independent of your cash flow needs for the year. The Roth conversion decision is just about getting the money over this tax hurdle at the lowest marginal tax rate that you can. Since the underlying investments that you can be in within a traditional IRA and a Roth IRA are the same, there's no difference between leaving all of the money over here in the traditional IRA versus moving all the money over here into the Roth versus any combination of the two, as long as, and here's the key which you've heard me say so many times before, as long as your tax rate never changes throughout the course of your life. That's what makes the traditional and Roth IRAs a tax rate play only. If we go over here to this tab, the Convert versus Distribute tab right here, if we assume that all of the traditional IRA distribution decisions that we went through in this video were actually just conversions, then you can see multiple scenarios right here. Here is the traditional IRA only with no conversion. We start with an opening balance of $2 million. We have a 2.5% growth rate with no distributions and a 24% marginal rate over the course of your life. The ending after-tax value of a traditional IRA in that fact pattern would be $3,110,539. But if we go over here to scenario number 2, here's a traditional IRA with conversion in the amounts that we were originally talking about in example 1. In other words, $64,500 of conversion this time instead of distribution. That $64,500 will be taxed with each conversion at 24%, assuming we're using money coming out of the traditional IRA to cover the tax, i.e. the tax is not being covered with outside funds. That would leave $49,020 to go into the Roth IRA each year. And with a 2.5% growth rate, the value of both what remains in the traditional IRA after 24% tax plus the amount that ends up in the Roth IRA after tax, the grand total of those two items is going to be $3,110,539. It makes absolutely no difference right here from a conversion perspective if you do nothing, if you convert at $64,500 per year, or if we scroll over here to the third example, which in this case we're just going to do a conversion of $90,000 for the first 8 years. Then we're going to do the $24,800 for the remaining years. The after-tax after-tax value that remains inside of the traditional IRA, plus the after-tax value that you receive inside the Roth IRA, the grand total of those is going to be $3,110,539. The Roth conversion decision is a marginal tax rate decision only. You can make this decision on an annual basis independent of your cash flow needs. It's just about getting the money across this tax threshold. When the money from inside your retirement accounts starts to impact your cash flow planning is when the money comes out of the IRA vehicles, because now you're making a rate of return decision by choosing to take some portion of the money out of these tax advantaged vehicles. And you're also choosing the amount of money to take out in conjunction with your choice about the internal rate of return on Social Security in this example. So you have two different cash flow streams, each with different rates of return associated with them, each with different rates of return that will change as each year passes. But I think the key takeaway from this chart is that the Roth conversion decision can be made based on your marginal tax rate only, with no impact on your cash flow planning for the year. In other words, keep these two steps distinct in your mind. You can take money out of the traditional IRA across the tax line and then out of the vehicle where it affects your cash flow. Or you can just take the money across the tax line only and just leave it over here in this other vehicle without the money exiting the IRA vehicles completely. And therefore, just this step right here in isolation can be planned for independent of the money coming out of the IRA vehicles and impacting your cash flow. By the way, my year-end 2025 Roth IRA Fast Track Training Series is blasting full speed ahead. The most recent video trainings uploaded to the members area include projecting traditional IRA growth through life expectancy, estimating RMDs starting at age 73 or 75, calculating income during the early retirement drop, and identifying room in the brackets during the Roth IRA conversion sweet spot years. If you're already a member of the Personal Tax Planning Template Program, you know where to log in and access the latest members' detailed trainings. And if you're not already a member, lifetime access to the Personal Tax Planning Template and Video Training Program is available for a one-time access fee at the link in the description below this video. My Personal Tax Planning Template Program is arguably the most complete and comprehensive individual income tax planning training program on the market in the United States today. Take a look at some of these recent comments by members of the program. Justin, your videos are so detailed and understandable. Thank you for helping us primarily old school retirees. And over here, thanks again for all your hard work and excellent education material. It is helping me to no end figuring out our future retirement taxes, Roth conversion, and trying different distribution strategies. And right down here, Justin, your spreadsheet is amazing, as is all of the work you've put into the videos within the members area of the Personal Tax Planning Template. It's like having a financial advisor report whenever I want for whatever changes happen or that I want to model. And then finally, right over here, Justin, I wish I had paid more attention to the tax implications of retirement when I hit 60, and I have encouraged others to learn from my mistakes. I'm now turning 73 this year and am facing large RMDs. As I said, you can join the Personal Tax Planning Template Program with lifetime access for a one-time access fee at the link in the description below this video. And that's going to be it for today's video. Thanks everybody for watching, and I'll see you next time.